Yeah. All right. So we are here on this very yellow Wednesday, the 24th on the calendar. Final term paper submission due today at 6 p.m. to me via email, obviously. I'll see the timestamp. You want to make sure that you're on time. There will be points deducted for people who are submitting late. So please make sure that you are not trying to hit send at 5:59 or something and then saying that your internet crashed or whatever. I mean, you name it, I've heard all the stuff that happens at the last minute. So please don't procrastinate. Remember the information for the term paper you've had since the beginning of the semester. By now you've chosen a company. I hope you remember. For those who haven't even started writing, I hope there's no such person in this group. But if that is the case, go back and see which company you chose. Please remember that it's the annual report of that company, the most recent annual report. So you have to check on the company's website for a Form 10K. That is the most recent one. I need you to work with that and not with a quarterly financial or just something you looked up on the internet. And these are this is the distribution of points. I'll be looking for these things. And, when it comes to the risks that the company faces, sometimes there's actually a section on the financials called risk factors. Sorry, it looks like that, risk factors. Often it's number one in some of the discussions and it's called risk factors. Maybe if you can't find the discussion of risks in the management discussion and analysis, look for something called risk factors. I'm looking for actual risks that the company is discussing, not risks that you've made up yourself, okay? Because I want you to be able to see what companies are saying, some of the risks they are facing, in whatever the market situation may be. And again, I'll just repeat, I said it might be easier to just make a table for the financial highlights of the company and then just write at the bottom of the table what you think. If you didn't make a table, that's fine. I'm not saying points will be deducted if you don't make a table, but I don't want to see people copying and pasting the balance sheet and copying and pasting the income statement. That's not analysis, okay? That's just you copying and pasting a page from the financial statements and not telling me that you can actually see which numbers are relevant, okay? So please don't at the last minute decide that you'd rather give more information and copy and paste stuff. Pick up what I asked for, right? Assets, revenue, expenses, liabilities, cash flows. So cash flow from operating activities or the change in cash flow for the year. I'm leaving that pretty broad. Earnings per share, okay? And you're really supposed to say, is the company stable, improving, or deteriorating according to your analysis and why? It's very rare that I'm going to say, that you're completely wrong here. Just write down what you think. That's the point of the paper, is to have you think about things. And then over here, where you talk about the most recent financial results, I mean, I'm talking about 3 or 4 sentences just saying, based on my analysis, the company's, improving or, deteriorating or whatever, and say why. You can heavily rely on what you just discussed above. And then remember I said on Monday about liquidity, solvency, and profitability. You're basically choosing one ratio for each of these. And calculating that ratio for 2 years to see how the company is doing. And please reference where you got the numbers from that you're using in the ratio. So if you're taking current assets divided by current liabilities, tell me the page of the financial statements that you got it from. If you're taking the calculations from some other source where somebody already calculated the stuff for you, that's fine, but please reference your source. And then the share price I mentioned, you can just take a screenshot of the change in the share price for the year or whatever, and discuss how the share price has changed over time. And then 2 stories. Guys, please make sure that you're not being repetitive. I find that when people are struggling to finish something maybe a little bit at the last minute, that they say the same thing over and over. Read your work before you send it and cut out any repetition. We're looking for about 5 or 6 pages. I'll probably, because it's a double spaced, if people want to write more, if you write, 7 or 8 pages, that's fine. But please don't go over 9 or 10 pages. I don't need that volume of work. I'm not asking you to do that volume of work. Try and think about what is necessary and not necessary. The paper really is just supposed to be about 6 pages. I'm not saying that I'm going to stop grading, if it goes longer, but for what I'm asking you for, it's really not necessary to give me more, than maybe 8 pages total. And then, when it comes to citation, I know I've repeated myself many times, but I'll just say it again. Here's the resources for the term paper. You have a paper here that shows sample citation. You need to cite within the document and have a reference page at the end. If you don't know how to cite your sources, this online writing lab at Purdue University is a very well-known resource for citation, so you can use that. You can also just use this paper to guide you on how to cite things. If you're struggling with grammar, I don't want to tell you to install stuff on your computer, but I can say that I have Grammarly installed on my computer, and it's very helpful. Or if you don't want to install it on your computer, you can go to grammarly.com and put your paper. You can copy and paste your paper into there's an area there that you can copy and paste it into, and they'll tell you, where to fix your grammatical errors. All right, so make sure you read the paper before you send it to me. If you're already done and you think you're good, but you haven't actually read the paper yourself, please do that. Okay, so those are the resources. We know the assignment is due today. I'm actually going to be going line by line to see whether you answered, the questions, and I'm looking for citations. Please don't give me a paper that does not have citation in the body of the paper and only has references at the end. It's not acceptable. I won't know what part of the paper is you're writing, what part of the paper somebody else is writing, and it could amount to plagiarism. Okay, so wherever you use someone else's, like a reference from somewhere else, just put the reference into by the sentence where you used it. Even if you're not sure exactly how to reference, it's okay, as long as you put either the website or you put the person's name, the page number, the year, or whatever, just enough so that I can find the information that you are referencing. But, don't give me a paper that has no references inside the paper and just has a references sheet at the end. It's going to be a big problem. All right. So if you have to go back and add references and stuff, please do that. So that's happening today. Questions? I'll leave you a minute or two for questions if anybody has anything they want to ask.
Professor, I do want to submit the research paper, but I think I will need some extra time. Is it okay if I submit it by Sunday? Is that possible?
It's due today.
Okay.
Yeah, you'll have to speak to me after class, but I mean, it's been due today since the beginning of the semester. So why don't you talk to me at the end of class so that I can understand what it is that you are struggling with, in terms of maybe there's some part of it that I can help you to. Maybe what I guess I'm saying is maybe you might be overcomplicating something and I can help you to simplify it.
Okay, okay.
And then we'll see based on that. But there was never any there's not extensions because it's been due for the whole semester. It's been due today. So if there's a very specific issue, then I can work with you or work with anyone. I mean, I'm not trying to be terrible about this, but it's not fair, to just start making such extreme, because today's Wednesday and you're talking about Sunday. I mean, it's a massive.
No, I forgot today was Wednesday.
Yeah. Let's talk. Like I said, I don't want to be unreasonable. I'd rather speak to people one-on-one and maybe I can help you resolve whatever the issue is. And if there's a need for some type of extra few hours or something that people need, I can do that. But I can't just give wholesale extensions like that because it's just not fair to the rest of the people who are, bending over backwards.
Yeah, sorry I said Sunday. I didn't mean Sunday. Actually, like a few hours will be enough for me.
Yeah, so why don't we talk at the end? And anybody else who's having a struggle, just stay at the end. You know, and let's say, you know, if it's a few hours, I'm not unreasonable. Like if someone says they need until midnight tonight or something, that's not a problem. But you know, I'm not giving days worth of extensions because other people working towards this. And I'm not picking on you, Pura. I'm just talking about, you know, in general. Yeah, but thank you for asking. So anybody who maybe at the end, I'll leave some time, like maybe I'll end a little bit early, then we can just talk through maybe what questions people have, where you're getting stuck, how much, you know, additional time do you think you need, and so on. All right, thank you for bringing that up. Any other questions? Hope I haven't scared anybody from asking questions now, because I'm like, there's no extensions, right? Okay, so why don't we do this? Think about your questions. Like I said, at the end, I'm going to leave time so we can handle it. Pura, please stay on so I can help you. And if there really is a situation that warrants, you know, a few extra hours, we can work through that. And the same goes for anybody else on this call. All right. The other thing that's due, I actually did extend because I'm looking at how many people, sorry, I'm not on the right thing here, how many people have even started the homework, and the number is low. So the homework was due on Friday, and I told you guys if you wanted an extension, I could make one, but no one asked for it. But then I looked at how many people actually did the homework or started the homework, and I can see that it's not even half, it's like a third of the class that you know, that is done anything. So I extended the homework to Sunday. And so hopefully that helps, I guess, the situation a little bit more for those who are scrambling to try and finish the paper. And then, so it's now due on the 28th, okay? You're scrambling to do the paper, you've got Thanksgiving happening, you've got people, you know, maybe you're traveling or you've got other people coming to you, whatever the case may be. I've extended the homework because the homework is a little bit less, it's lower stakes. I don't know what that means for the chapter 13 homework because it's supposed to be due on the 1st. I may have to wiggle that around because we're coming to the end of the semester and there's very little time left. But I need people to do the chapter 12 homework because it's going to, those questions, some of those questions will be on the final exam. So I don't want to close it out by Friday and people haven't actually done, you know, done the work. And I know that Thursday is normally a family day for everybody. So I feel like you might only have a few hours to do the homework, and that's not going to be a good look. Okay, so Sunday for the homework, today for the paper. If you're having an issue, and I'm talking about like a technical issue or something that where I can support you, stay after a class and I'll try to help you. Please don't stay after class to tell me you know, I mean, stay off the class, but I mean, if you're saying something like you haven't even started or something like that, guys, I mean, I've been reminding you all along that this paper is due. We even had an early submission. There's a level of personal responsibility that has to come into play, okay? So just think carefully about what you're asking me when you stay at the end of class, so that it's not putting me in a position to be unfair to the rest of the class. Because to me, that's very important that I'm being consistent, all right, with deadlines and things. All right, so that's the story with the schedule. Final reminder again, if you haven't registered for fall 2 or you haven't registered for spring 1, if you need to register, I know some of you are transferring out, but if you have to register for classes, please do so. You know, the numbers are not that high, and I don't want anyone to end up being in a class that gets cancelled because there's not enough people in the class, and then it's just because people haven't registered yet. So you know, over the weekend or next week or whatever, make sure that you remember to register if you haven't done so. If you're registering for fall 2, remember that your vaccination records have to be uploaded by December 11th. If you're registering for spring 1, your vaccination records have to be uploaded by February the 23rd. All right, so that's also something to keep in the back of your mind, that you can't, if you're going to register for hybrid or in-person classes, you need to have your vaccination stuff on point. All right, the last thing that I wanted to do was like from an admin perspective was just to talk about what's happening in the in the studio hour, because it's happening right after this. I know some people may be really overwhelmed because the paper's due today. So, you know, you decide your level of involvement here. If you need to prioritize the paper, then do that. I hope you're hearing me. If you need to prioritize the paper, then do that. Okay, but for those who are done with the paper, or, you know, you're close to done today, between last week and today, you had this to do, which was really just to finish the career section of your e-portfolio and upload your resume. So I just wanted to show you here one of your colleagues, Zhao. I hope I'm pronouncing your name correctly. You can you know, check me. And I did ask for permission in the chat, but I didn't hear back from you. So forgive me if I'm taking liberties here. But Zhao Yi did the career planning stage, talking about being an accounting major and wanting to pursue the CPA license, and you know, talking about listening to lectures and experiences about finding jobs and so on. And so it's just a little blurb, right, about a paragraph that Zhao Yi has done here. So I just want to, okay, thanks. And then the resume, right? The, you know, what's happening with the resume. Over here on your resume, you can probably write a little bit more. I'm not saying that you have to do this for me, Zhao, but if you look at some sample resumes, you could probably see that you know, there's maybe a little bit more information that is given in terms of the work that you're doing, so that someone can see, you know, exactly how, like, what types of skills you are employing at your job. But and for education history, sometimes we put key courses like your accounting courses and so on. But for now, this is your resume, and you know, your information is here, which is great. And I just wanted to share this, and you also have a resume tab here. I just wanted to share this with those who are going into the studio hour today, and, you know, wanting to make sure that you know what's expected here. This is for 10 points each. Something that looks like this will probably be, you know, I'm very, I told you, when it comes to grading this, I'm very gentle with the grading. So this person would probably get 10 out of 10 for both, right? The resume is not necessarily, you know, a perfect resume from the perspective of how robust it could be, but the purpose of this section is not to build a resume, it's just to you know, display your resume. So this is like 100%, and you're done on that work. All right. So does anybody have questions about that piece of the work that's kind of being done between last week and this week?
Sorry, Professor, can you go back and can I see it? Can I see that again?
Yeah, sure.
The resume thing?
Yeah. So Zhao Yi added the resume over here as like a module.
All right, thank you.
And if you, Emdadol, remember you have the resume tab. So if you added the resume, I know I can't see this here. So maybe Zhao, you also added the resume over there, but I just can't see it. But if you put the resume as a separate tab, because remember last time I showed you, I think it was your e-portfolio where you had a separate tab, that's fine as well, as long as I can see the resume, right? Whether it's here or on a separate tab, not a problem. As long as it's published and I can see where your resume is located.
Okay.
Was that your question? I feel like maybe that's what you were concerned about.
Yeah, that was a question. Because it's not still like seeable, that's why. And I also to go talk to the Reja or to
Oh,
him.
you still can't see. Oh, okay. So
like I can see at my end, but after like the people you know, can't see it. That's
yeah,
why.
I don't know what's going on there. Zhao Yi, did you also put your resume here and publish it or no?
No.
Oh, okay, because I thought maybe it was the same problem that Emdadol is having, where he put his resume, but no one besides him can see it. You know, Emdadol, if you want to, we don't have to do this, but if you want to, during the break, you can share your screen with me and I can see if maybe I can figure out why we can't see your resume, because maybe there's just a publishing that hasn't happened somewhere, okay? If you want to.
Okay.
All right. So that's,
Professor,
yes.
I put my resume in a resume template.
Okay. So are you concerned that that something's wrong with it, or you're just telling me?
I'm just telling you, you can say it or not. Can you check?
Oh, you're asking me if I can see it. Okay, I understand now. Yeah, I see you. Yeah.
Okay.
So Zhao Yi, this is what I meant. I mean, I'm not saying that you would have all this stuff that Jaron has, but maybe making the bullet points a little bit more into fuller sentences with what you're saying. And sometimes it depends. I mean, some people put education last if they have a lot of jobs and stuff, and some people like I was at school so long ago, so my education is probably not as important, so I might put it at the end, whereas you guys are still in school, so that might be more relevant to someone like looking at this. And Jaron, I'll edit this out of the video, okay, because I don't want your personal information to be on YouTube, so don't worry, I'll edit it out of or I'll edit this whole segment out of the video for today. But so don't worry, but basically this is, you know, the type of thing that we're looking for, whether you put it on a resume tab, which is really the instruction that I gave, right, to put it on a separate resume, or if you put it here, it's fine. Okay, I'm flexible with that. I just want to make sure that your resume shows up somewhere and that you actually have a resume. Are we good? Jaron, you're okay?
Yes, Professor.
Okay.
Thank you.
Emdadu, at one point your hand was raised. Are you fine now, or do you still have a question for me? Emdadu, I guess you're okay. Okay, any other questions about e-portfolio before I move on here? Okay, so one last thing that I'll say is I'm looking at December the 9th as the as like sometime like midnight on December the 9th as like gonna be the final deadline where everything on the e-portfolio should be done. Okay, so I'll send out a mail about that. I'm still trying to figure out the dates and so on, but December the 9th will probably be, so it will be the day after you have your last studio or reg hour, just in case you still have questions and things. So that gives me some time. Remember, I have to mark like 18. I'm checking that people are doing the work, but I haven't attributed final grades to anything because I want people to have an opportunity to fix their work if there is a problem. So from the 10th onwards, I need to be able to mark all the e-portfolios. So I need a few days to do that. That's why I'm giving you guys. Theoretically, everything was due on whatever the due date is over here, but I know that people are not making the due dates. So I'm giving you the date of December the 9th as after that day, anything that's not there is not getting any points. I hope that makes sense. All right. So for those who are struggling with the term paper and so on, please focus on that for today. So you can just get that done and don't worry about, you know, I'm showing this to people who are going to the reg hour today. If you really cannot function, like you need some time, then I would say you go to the reg hour and use some of that time to actually just work on the term paper. I think that at least you can hear what Raphael is saying to the rest of the students, but I think if you need to work on the term paper, do that. All right, so that's it. Gion, did you have something to say or no?
I'll talk with you after the class.
No problem. Fine. So I'll leave maybe 20 minutes or so at the end of class just for anybody's questions and concerns and what have you, and the rest of the people can go and you know, like I said, attend. I'm not telling you not to attend the reg hour, but I also understand that we need to be flexible. So if people need to spend some of their time to work on the paper, then do that. All right. So let's go into chapter 13 and you know, we finished chapter 12 on Monday, and you know, you guys are in a position to do all of that homework, and there's really nothing else to say there. So I'm going to start chapter 13. So current liabilities and contingencies is, you know, the name of this chapter. So we already kind of know what a liability is, but we'll go a little bit deeper into the definition of a liability and then what a contingency is. And you know, in this chapter, it's a little bit less how can I say it? There are calculations and journal entries, but there's also just a lot of, like, I guess, theoretical things like, you know, how questions like how would you account for something and so on. So unfortunately, at the beginning of the chapter, there's a lot of talking, you know, by me talking about the different types of liabilities and the different types of contingencies, but we obviously also have some examples that we will do. But I'm just warning you in advance that there is going to be, you know, a lot of talking about the definitions of different types of liabilities. So we've got this chapter, the current liabilities, and then the chapter 14, which is going back into like long-term liabilities, bonds and things like that. It's basically the other side of debt investment. So in chapter 12, we were the investor and we were buying this asset, a debt investment. In chapter 14, we are the borrower. So we're going to have a liability, right? A bond payable and, you know, notes payable and things like that. So let's just focus here first on these current liabilities and contingencies, and, you know, we'll deal with the rest as it comes along. So obviously we already know this from long ago, like accounting 1, right? Assets equals liabilities plus owner's equity, or if you are you know, looking at it from a company perspective, stockholders equity. So when you think about liabilities and owner's equity, they are the ways in which we find sources of money to fund our assets, right? All the assets that we have are either funded through equity that someone put into the business or borrowings that we made, you know, to be able to pay for them. And so most liabilities have result in some obligation, right? That we have to either pay cash or we have to do some type of action, service or whatever. And many are legally enforceable. They're, you know, it's not just a casual arrangement that says maybe I'll pay you back or whatever. It's an actual legal contract. But there are some liabilities that are more to do with a you know, you're going to do a service or transfer assets, and it's not to do with paying cash. So, you know, things like unearned or deferred revenue. Remember, when you receive the money before you actually perform the services, so you are not allowed to record the revenue yet, and you have to wait and record it later when you've actually performed the services, right? Or if there's some type of asset that you have to, you know, give up to someone, but you're not giving it up yet, then there's some obligation to perform in the future. So if we look at the actual characteristics of a liability, right? There are probable future sacrifices of economic benefits. So it's probable that you will have to pay out something in the future, or you will have to give an asset to someone, or you will have to render a service. And that's because you have a present obligation, right? Right now, you have an obligation, meaning you owe something to someone, and that obligation resulted from a past event or transaction, right? So liabilities exist in the present, the past, and the future, or that combination of things results in a liability. So it's a little bit, you know, intricate, because it's a present obligation as a result of a past event that will cause future sacrifices of economic benefits. And if one of those three elements is not present, then it's really not a liability, right? There has to actually be an obligation. There has to be a reason why that obligation exists, which is the past event, and you have to pay or you know, give out something to settle that obligation. So We also, and we'll deal with this a lot in this chapter, we know that liabilities in a classified balance sheet, they're classified between current and long-term liabilities. There's not really a classification by the nature of the liability, like you don't put all the bonds payable together and all the notes payable together or something like that. They're classified based on time, right, when they will be due. And remember, current means that the liability will be settled within 1 year, and you have to say 1 year from when, within 1 year from the balance sheet date. Okay, it's always from the balance sheet date. And long-term liabilities will be settled in more than 1 year from the balance sheet date. So that's the, the conceptual framework around liabilities. Present obligation resulting from a past event, and it will lead to the future sacrifice of economic benefits. It could be current or long-term. And so the focus is current liabilities for us, right? And when you look at current liabilities, they are called that because they're expected to, require you to pay them off using current assets. So when we say current assets, we're talking about cash, we're talking about accounts receivable, inventory, things of that nature. So somehow either through actual liquid cash or through selling off some of your current assets, you're going to be able to settle, right, those current liabilities, or you have to borrow again, right? You borrow and create some other current liability to settle the first current liability. So that's that's the type of I guess that's the thinking around why something would be classified a current liability, is that you have to use current assets to settle it or create another liability to settle it. So maybe you have accounts payable and you're struggling to pay that off with cash. So you go to the, I don't know whether the bank will lend you the money, but let's just assume that you go to the bank and borrow on a 3-month note and get the money and use that money to pay off your accounts payable. So you created another current liability to pay off your accounts payable, which is a current liability in and of itself. Or you have an accounts payable balance and you use the cash that you have on hand to pay off that balance. Same thing, you also paid off the current liability, but you paid it off with an asset. I already said they're payable within 1 year from balance sheet dates, and they aren't present valued, okay, because they're due so soon. They're due within 1 year. So you don't have to record. Remember when we did like the asset retirement obligation and we used those present value tables and we actually recorded the present value of that obligation on the books? With the current liability, you don't have to do present value because it's due within 1 year. So present valuing it for 1 year is not really useful. So we just record it at full maturity value. All that means is, let's say we buy something on account for $100, the liability will be $100. We're not trying to make the, to do a present value calculation and then increase it to future value over time. So what you know about how to record a current liability is exactly what we are still doing. All right, so any questions up to there before we go into the types of liabilities? Remember, I said there's a lot of talking, and I'm sorry. That's the nature of, I guess, the start of a chapter, and also, I guess, this chapter itself. So any questions? All right. So types of liabilities, types of current liabilities, we have many. If you've downloaded this document from Blackboard, you can see that there are many, right? It just goes on and on and on. So, but don't freak out, okay? Because, it seems more involved than it really is. Some of the stuff we already know about. And we will do, as many calculations or many examples as we can to make sure that everybody understands everything. So accounts payable, this is a classic current liability. Balance is paid, right, to others for goods or services purchased on account. trade notes payable. So it's slightly different from accounts payable because there's an actual document, a promissory note. And they're also a bit longer term than accounts payable. So if you have a business, you could just have a straight accounts payable. Maybe you buy from a wholesaler and you have to pay it back within 30 days or 45 days. That's your accounts payable. But sometimes you could buy from another company and they actually give you a longer time to pay, maybe 3 months or something, but they want you to sign a document. Like a promissory note is a promise to pay the money back, and there may even be interest, on that. So trade notes payable, slightly different from accounts payable, right? And then we also have some other short-term notes that are, interest bearing, or what they call zero interest bearing, but I'm putting, quotes because nothing is zero interest. Maybe when you transfer from one credit card to these zero interest specials that they have, right? Sometimes you see, oh, transfer your balances and you'll get 0% interest, but then you have to read the fine print that there's actually a charge to transfer the balance at 0 interest. So they'll charge you maybe something like 3% of the balance that you're transferring as a transfer fee, right? And then you pay 0% interest, but actually the 3% is a type of interest. So I guess what I'm saying by saying this is that there's, as they say, in English or in America, there's no free lunch, meaning that you're not going to be able to just transfer your money all over the place with no interest. Similarly, with these short-term notes, there's no such thing as zero interest bearing. They'll just say that the note is discounted, but it actually just means that you are paying interest. You're just not paying it, over the term of the note. You're basically paying it at the end. So I'll explain it some more here. So with interest bearing, this is what we know, and it's obvious, right? Interest bearing interest is calculated as the face value times the annual interest rate times the time to maturity. So if it's a 3-month note, you'll take the face value, the interest rate, and then multiply by 3/12 so that you can apportion the interest just for the part of the year that is actually applicable. Right, and it's 3/12 because the interest rate is always, that's quoted, is always an annual interest rate. So you have to factor that into your calculation. And so when you borrow with an interest bearing note, you receive the face value of the note. That's going to be the amount of your liability. But when it's a zero interest bearing note, you receive an amount that is less than the face value of the note. And I'll do 2 examples with you here in a second. And the note is recorded at face value, but the difference between the cash that you actually receive and the face value of the note is a discount on notes payable account. All right, so that's the discount account is what becomes interest expense. So we've gone 1 through 3, and I think it's a good time to look at a few examples here, so we can just break it up a little bit. So we've got, I think it's like these first 4 examples are to do with calculating interest, and so let's hit these examples to keep everybody awake, basically. So Chapter 13 examples, again, all on the same document that's on Blackboard. This is page 6 of that document. There's also the class example workings. The link to that is also on Blackboard. So Upland Company borrowed $40,000, right? So there's, your liability on November the 1st. So watch the dates, because as soon as you have to calculate interest, you got to be very careful with dates, 2012. By signing a $40,000, so it is the face value, 9% is the annual interest rate. 3-month note, that's the term of the note, so it's obviously a current liability. Prepare Upland's November 1st, 2012 entry, so that's for the actual borrowing. The December 31st, 2012 annual adjusting entry, so that's to accrue the interest on the note. And the February 1st, 2013 entry, so if it's November, December, January, by February the 1st, this is when they're paying off the note. All right, so that's what they mean by the February 1st entry. Okay, so if you haven't if you haven't downloaded this document, maybe just take down the important information, or you know, take a picture of this question, because I'm going to go between the question and the answer page now to be able to show us all how to do this. You guys already know how to do this, but I just want to make sure that you have the question. All right, so exercise 1. So November the 1st. All right, so on the day when they're borrowing with a note, that's not going to be too, this is really not rocket science. Obviously, you're receiving cash, so it's cash for 40,000, right? And you create the liability notes payable for 40,000. Oops. Okay, so that's the borrowing using the note. Now we come to December the 31st, when they have to do the interest accrual, right? Or the that's the adjusting entry, right? That's either way, it's the same thing. And so the purpose here, again, in this chapter, is to make sure we know how to record the current liability, how to account for interest as well. Interest is also a current liability. And, you know, to make sure that you know how to also make the journal entry for paying off the interest. So if we think back to what we said, calculating interest, the face value times the annual interest rate times the time to maturity. But between November, this is an adjusting entry, right? November 1 to December 31, how many months have passed? It's not the 3 months, right? Of the term of the note. It's all of November and all of December. So only 2 months have passed. So because this is an adjustment, we are not doing the full interest amount, right? So 40,000 times 9% times 2 over 12 is what we will be doing, and that comes up to $600, I believe. All right, and then just stop me if there's any questions, because I'm making an assumption, and I hope I'm not wrong, that a lot of people are familiar with how to calculate interest, and that I don't have to laboriously explain, especially because we did some of this already when we were doing the asset side, right, the investment side of it. So you've got an interest expense here because we're borrowing, so it's an expense, right? And interest payable because it's an adjustment that's not yet the actual payment of the interest. So that's the December 31st, the adjusting entry, or interest accrual is another way of saying it. All right, and then just going back to the question, make sure, so we've covered the actual borrowing, the adjustment, and now February the 1st, which is the repayment of the note and the payment of interest. That's what we're doing on February the 1st, all right? So here, repayment of note and payment of interest, because at that point we haven't paid any interest yet. So this is February the 1st, 2013, all right? And from December the 31st to February the 1st, or we could say January 1, right, to February 1, that's 1 month of interest. So we have to account for that extra month, which we hadn't accounted for yet. So it's going to be 40,000 again times 9% times 1/12, and that's going to be $300. So or you could just calculate what's the total amount of interest on the note, and it's obviously $900. And since you had already accrued for 600, the leftover amount of interest is 300, right? Either way, you know, the total interest, again, if you just wanted to do it that way, total interest would just be 40,000 times 9% times 3/12, and so that's 900, and you know you're basically in the same place. So at this point, we will do the repayment of the note first. So it's notes payable. You're basically flipping the journal entry from November the 1st. That's 40,000 debit to notes payable because you're paying off the liability, and cash is a credit, right, of 40,000. I'm separating the journal entry for the payment of the note and the payment of the interest. You can do them together, but it does get a little bit messy, but I'll show you how to do the compound entry as well. And then on the interest side, you are going to get rid of the interest payable that you accrued over here, right? That's 600. And then there's the interest, the actual interest expense that you are recognizing for the first time. That's 300. And then there's also cash that's being paid, 900, right? So because both of those journal entries involve cash on the credit side, you can compound, right? So all compound. Sorry, that's a compounded, it's missing an O. Compounded entry. So how does the compound entry go? You're going to say notes payable again, the 40,000. Interest payable for the 600. Interest expense for the 300. And cash for 40,900. Either way is fine. Okay, so if you want to do the compounded entry, or if the McRoyal Connect asks for the compound entry instead of the split, that's how you would do it. Just put all the debits first, and then cash is the only credit that you have. Questions on this one? Exercise 1. Okay, so I'll leave it up for 30 seconds to a minute or whatever, so you can, anybody who's copying stuff can copy down. After this, we're going to do a zero interest note to show you how to do the accounting for that. Okay, so about just when the clock hits 11:24, I'll move on to the next question, which is about a zero interest note. All right. So back to the questions, looking at number 2, okay? Number 2, Takemoto Corporation borrowed $60,000. So there's the amount, right? That's the face value of the borrowings on November the 1st, so same date as the previous question, by signing a 61,350 3-month, there's the term, zero interest bearing note. Now, all of us can see that, you know, clearly there must be some interest because they're borrowing 60,000, but they're going to pay 61,350, right? Prepare Takemoto's November the 1st entry, the December 31st adjusting entry, and the February 1st, 2013 entry to pay off the note, right? So this is a zero interest note. When we first record it, we'll have to record a discount on notes payable, and I'll show you that in a second. just take the question down if you need to, or I don't know if anybody, or if you didn't, right, if you didn't download the question. So what did I call this above here? Borrowing using a note. Okay, so I'll just stick with the same language. So borrowing using let's call it zero interest. So we know that this is a little bit different. Right. And it's 11/1/12. Okay. So the cash that you are receiving is only 60,000. All right. You receive less than what you are going to pay out at the end. That's why it's actually not zero interest. It said that it's a 60,000 or borrowed $60,000, right? But with a 61,350 note. So again, you receive 60,000 in cash, but the notes payable is higher. What you owe is 61,350. So there's a difference here, right, between these two numbers. And this is called discount on notes payable. So you have to actually recognize it's not interest expense at this time because the time hasn't passed, right, for interest to actually accrue, but you have a discount at the date of borrowing, and over time the discount is going to be amortized and it will be recognized as interest expense. And I'll show you those journal entries here in a minute. I just want to give people a chance to take down this first piece, and if you have any questions you can ask them now. Okay, so now we have the adjusting journal entry, right, that they were asking for at December the 31st. And so all that is you're going to do a straight line, which means, just even straight line amortization of the discount and recognize interest expense. That's what this adjustment is going to be about. So what does that mean, right? The term of the note is 3 months. So discount amortization for 3 months as well. And I'll say discount to be amortized per month, right, is going to be 1,350 divided by 3 is 450 per month. So we have to recognize $450 of the discount per month to amortize it to interest expense. And so now the question becomes how much time has passed. So November the 1st to December the 31st is 2 months. So $900 will be amortized. So I'll leave it up. Ask me if you have questions, and then I'll do the journal entry for this. Okay, so you're going to debit interest expense because you have to recognize interest for 900, and you're going to credit the discount on notes payable. So the discount balance, just like what we saw with investments, the discount balance will get smaller and smaller as time goes by until the maturity date at which the discount balance will be zero, and it would all be recognized as interest expense because the nature of this discount, right, quote unquote, is actually interest, right? It's clearly interest, but for some reason they're calling it a zero interest note. So that's the adjusting entry. You recognize interest and you get rid of some of the discount. Questions there? Okay, so then we come to February the 1st, where we have the repayment of note and discount, right? It's not payment of interest, it's just an additional discount amortization that we recognize, okay? So this is February the 1st, 2013.
Professor, could you pause for 1 minute to write down
Absolutely.
everything?
Yeah,
Thank you.
yeah. I can pause for many minutes if you, however much time you guys need.
Oh, I'm done. Thank you.
No problem. All right. So when it comes to repaying the notes, remember you're going to debit the liability and credit cash. And then you also just want to recognize the remaining piece of the discount that has to be amortized, right? So you debit notes payable with the 61,350, which is what we actually borrowed. You're going to credit cash because now you're paying out, right, the amount of the note plus this interest that is not interest, but it is actually interest, okay? And then there's one more month, right? Because it's 3 months, you recognize 2 months. So there's one more month of this discount that needs to be amortized. So it's going to be interest expense, right, for 450 and discount on notes payable also for 450, right? This is the final month of amortization. And of course, you can combine, if you want to, you can combine this journal entry, you combine the debits and credits into one. I'll show it for compound entry. So notes payable. 61350, interest expense, right? I'm just combining the debits and the credits to make a compound entry. It's not rocket science here. Cash, 61,350. Notice how the discount, right? That last piece of the discount, it's not a cash payment. We are paying the full amount of cash against the note, but the interest numbers are the interest amount is between interest expense and discount on notes payable. It's not really interest expense and cash like our previous example, but don't be fooled. The $1,350 is interest. Right? It's obviously interest, even though it's a zero interest loan. Okay, so we'll break here until 11:45, 10 minutes. And I'll leave this up for a second so people can look at it and copy stuff down. And I think Emdadol, if you're still wanting to do it, I think during the break you wanted to show me the problem in your e-portfolio. So I'll give people a minute to copy down the answer here. And if there's anyone who still has questions about this, ask me. But then Emdadol, if you want to show me your e-portfolio, I'm open to looking at it for you. All right, so we're on break, right? If any Emdadol, if you're around, I can't hear you. If you want me to look at your e-portfolio, let me know. Anybody else, if you have e-portfolio questions, you can ask me. And any other questions to do with the term paper, we'll do at the end of the session.
Can I share my screen?
Oh, are you
Is it
ready?
okay?
Okay. Yeah, let me just stop my share. So, and then I have to make you the co-host so you can share your screen. All right, go ahead. Okay, so you see your resume. But it says you're interacting with the instructions section. I wonder if I wonder if it's because you pasted your resume in the instruction slide that no one can see it, because I'm not sure that the instruction slide is actually visible to anyone. Do you see there was a note that was up. I don't see it now anymore, but you see, yeah, only viewable while editing. So because you pasted your resume into the instruction slide, I'm never going to be able to see it. What you need to do is add a module onto this resume tab and put your resume into that module, not into the instruction slide. So if you see on the side here, there's like a little, not that lock, no, lower down. Yeah, over here by this gray where it says instructions only viewable while editing. Yeah, or actually try the white. Yeah, so at the moment you've added your resume In here, it shouldn't be here. I see you were going for the white cross or the white addition sign. I think that's what you need to do to add a module. Yeah, not, I think it's gonna be like either upload. The thing is, you don't want to do it in the instruction slide. You may have to add a rich text where it says section or rich text. Yeah, more ways to add content. Yeah, maybe section. I can't remember if it's section or rich text. Let's see if you, okay, so hang on. So what's happened now? Is that the section? Oh, but now you've added into the instructions slide. Oh yeah, you know what, MDiddle, you can just scroll down again where it said my resume. You can actually just, add content over here and publish it, and we'll be able to see it. And then, so upload file, exactly, upload your resume, and then then you can just remove your resume out of the instruction slide afterwards. So find your resume, wherever it may be. I see it there. I just saw it a second ago. Did you find it? What's happening? Are you trying to find it? That's the instruction slide. Yeah, get out of, okay, you can, exactly. So delete that. Yeah. Now you got to publish changes right at the top where it says publish changes. Scroll right up to the top of your e-portfolio, not just of the resume page, of your actual e-portfolio. Or publish page. You can do it that way also. Yeah, okay. Yeah, so now I should be able to see it. I can test for you if you want. But I think hopefully you understood now what happened. The main reason that no one could see your resume was because you put your resume in the instruction slide, and that will never be visible to someone outside. The instruction slide is only visible to you, okay?
Yeah, can you please check just in case? I mean, just
Yeah,
make
can
sure.
you stop the share so that I can, okay. I'm just taking you off as co-host, and then yeah, I can see it. I'm just gonna, just 1 second, please. I'm just gonna share my screen so you can see that I can see it in middle. All right? It's there. All right?
All right, thank you.
Thank you. Yes, Marina.
Yeah, so what page should I post my resume?
Let me look at your e-portfolio to see what you've
Yeah.
done so far. One
I-
second.
Actually, I think I heard career planning late stage. No?
Yeah. You can,
Yes.
that's fine. Fine. Like I said, I'll
Okay.
accept both. You can either do a separate resume sheet, which was what was on the original instruction, but if it's easier to just put the resume right below your career planning, that's perfect. Don't change anything. I'll be, as long as I can find it. That's
Okay,
all.
thank you so much.
Okay.
Thank you.
Mhm. Right, so we're back from break. It was it's 11:45, right? It feels like the time went so quickly now. But we're back from break. I'll be sure to end the class at about 12:25, so we have enough time at the end for people to ask me questions and stuff. I realized that I wanted to do a discounted note question with you guys that didn't actually tell you the interest amount, where you had to calculate the interest amount, but actually forgot to put this into the series of questions that I gave you. So what I'm taking brief exercise 13-2 from the textbook, and I'm just going to work it through with you. I don't think if I copy it into this thing, it's going to come out really well. I'll try, but it's possible that it's just going to look horrible. Oh, it doesn't even, it didn't even copy. Hang on. Oh, it's not even letting me copy from here. Okay, so I'm gonna read the question here, and maybe I'll be able to update the exercises to add this one. But the reason I'm doing this is because this question is a little bit different. It tells you that it is a zero interest note, but it just tells you that it's discounted at a 12% discount rate, and I want to make sure that we know how to treat that. With this other example that I just did, they told us, in essence, they told us the amount of interest, because you can see that's $1,350, but we didn't do one where they don't tell you the interest and you have to calculate it yourself, okay? So, so let's do this brief exercise 13-2. Since I actually can't, for whatever reason, copy the question right now, I'll just toggle again between the question and the answer. On October the 1st, Eder Fabrication borrowed $60 million and issued a 9-month, so that's the term of the note, promissory note. Interest was discounted at issuance at a 12% discount rate. Okay, so they're saying discounted at the 12, but they're basically saying it's 12% interest. Okay, that's a weird way of saying that it's going to be an annual interest rate of 12%, but obviously you've only got a 9-month term on the note. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note at December 31, the end of the reporting period. Okay, so let's take one step at a time. The journal entry for the issuance of the note. So it's a 60 million note, but you aren't actually getting $60 million, right? You're getting less than that, because the difference is going to be the discount on the notes payable. Hopefully everyone understands that. Take a picture if you need to, but I will go back and forth between the question and the answer. So I'm just calling this BE 13-2, kind of like see the textbook, right? To find the question, because I can't copy it over here. And so now let's just do the issuance of the note. Oops. Issuance of the note journal entry. And then the interest. Well, interest, but they won't call it that. So you're going to receive cash. There's going to be a discount, right? You already know that these are going to be the accounts that you will use. There's going to be a discount on the notes payable, and there's going to be a credit to notes payable. We know that the note itself, you will owe 60 million, right? So you might as well put that in for now, right? Now the question is, what does it mean? What's the calculation, right? The calculation for interest is, and interest is basically the discount. How do we do that? It's the same idea. It's going to be the face value, just like what we said before, times the annual interest rate times the time to maturity. Face value multiplied by the annual interest rate multiplied by the time to maturity. So the face value 60 million. And the interest rate was 12%, and the time to maturity is 9 months, okay? Because they told us it's a 9-month note, so it's 9/12. the 12 is because, not because the interest rate is 12%, but because there's 12 months in a year, and this is the interest rate for a whole year. And so in the end, you will find that if you do the math, this is going to come out to 5,400,000. Okay, that's the amount of the discount. Questions up to there? Okay, so what I'm showing you is the question doesn't tell you the interest, but it tells you the note has been discounted at a particular percentage. You basically go through a standard interest calculation to calculate the amount of the discount. So now we know that the discount / interest, right, is 5,400,000. So the cash that you receive is less than that, than 60 million, excuse me. It's going to be 54,600,000. So that's how we make the journal entry for the issuance of the note if it's a non-interest bearing note at a discount of 12%. And the date for this, I believe, was October the 1st, but let me just, sorry, I'm going to come back to that in a second. I just want to check the date. Okay, October the 1st. So let me also just put the date, because then after this we have a December 31st adjusting entry that we have to make.
Professor?
Yeah.
Can you please show me again the instruction, brief exercise 13?
Yeah, of course.
Thank you.
There you go.
Thank you.
No problem. Okay, so we did the journal entry for the issuance of the note. Now we have to make the adjusting entry at December 31st, the end of the reporting period, which means what they're really saying is recognize the discount amortization and then the interest expense, just like what we were doing before, okay? So here's the adjusting entry. It's going to be a discount amortization, and we have to figure out how many months have passed, right? So discount amortization. And it's going to be from October the 1st to December the 31st. So October, November, December. So 3 months have passed. So we need to amortize 3 months of the discount. So you can do this a few ways. I mean, the discount is for 9 months. So you can just say, you can just take a third. Basically, there's all kinds of ways to do it. Or you can do it over again with a interest calculation. It's up to you, but I guess, I don't know. I think it's easier to just say the note is for 9 months. And we're recognizing 3 months, right, of that. So, so 5,400,000 divided by 9. I don't know what that math is. Sorry, my brain is not fast enough. 5,400,000 over 9. So 600. Let me check this math. 600,000. Yep. Okay. Per month is the amortization. And then obviously for 3 months. So 1.8 million, right? So that's what we're going to recognize now. That's what's been amortized. Again, you can do this a different way. You can do the 60 million times 12% times 3/12 if you want to, but that's just, reinventing the wheel, or whatever works for you. And then, it doesn't matter as long as we get to the same answer. Whatever you think is the better option is fine by me. So you're going to do debit interest expense 1,800,000. And you're going to credit discount on notes payable 1,800,000 as well. And then we've answered the question. They're not asking for the repayment or anything. They're just asking for the issuance and the adjustment. Questions on any of that? Because this is a little bit different from some of the things we've seen in the past, right? We've seen notes, we've seen interest calculations, but this zero interest thing is a little bit different. I'll give you some time to take down the answer. Okay. All right, so I'll go back to the notes and we can look at a few more of these current liabilities. Okay. So we've done all of that. Yes, some of this will come up in examples that we'll do together, you know, a little bit later on once we've gone through the nature of, I guess, all of these notes. I think we'll be able to answer, you know, all the questions, but just bear with me as I go through some of the theory. A line of credit you may have heard about before. Maybe if you have a business or your family has a business, normally go to a bank and try and secure a line of credit for a certain amount of money. It's not an actual borrowing. It's kind of like the right to withdraw money when you need it. So someone might say, I have a line of credit with Citibank for $100,000. They don't owe anything to Citibank until they start drawing down the money. So this is also, you know, something it's like a formal agreement that is made, and then the company can draw down the money as and when they need it. And even though it is a current liability because it will have to be paid back fairly quickly, some of these lines of credit, you know, the companies have agreements with the bank for many years, but just because the agreement is with the bank for many years doesn't mean that it's actually a long-term liability. The line of credit has to be paid back fairly quickly. So that's something that just it's a tool that companies often use, especially if they have a business that goes through cycles. Like maybe now, for instance, this is holiday time, so some businesses make a lot of money during this time, but at other times of the year they don't make as much money, so they might need a line of credit maybe during the summer when they don't have as much business to be able to still pay their bills, and by the time the winter comes around and they're making money, they just pay back the line of credit. So that's how a line of credit works. A secure loan is just a short-term loan, but you have some type of security or collateral against it. So you use inventory or accounts receivable or something like that. So you go to borrow money from whatever lender, and they say, okay, we're willing to lend you the money, but you have to give us something as security for lending you the money. So maybe you'll say, I will pledge, you usually say my inventory. So that means that if you don't pay back the loan, they have the right to take your inventory from you. And this is often something that, or not often, it has to be disclosed in the footnotes of the financials, because, you know, a user needs to know that your inventory is actually subject to being taken by a lender, because that means, you know, any future revenue from that inventory is not necessarily going to be you know, received by you. Or it could be accounts receivable. They could actually take your accounts receivable and sell them off to someone else that will collect the accounts receivable just so they can get the money that you owe. That's a secure loan. Commercial paper is just big companies getting financing. Instead of getting it from a bank, they get it from other companies. So another company is, you know, the source of the funding, and that's why it's called commercial, because it's company, you know, a company is basically loaning money to another company. All right, and again, this will come up later in some of our examples. I'll just keep working through the examples. So these were all examples of accounts payable and notes, right, that are current liabilities. Okay, and then we come to some accrued liabilities. Some of them we've actually already done here, but I'll go through it. Accrued liabilities is liabilities that we accrue, meaning we actually record them in the financial statements that we owe them for expenses that have been incurred. So the expenses have happened, but they haven't yet been paid. You know, so there's some type of expense and then a liability against it. And it's normally done via adjusting journal entries. We've just done 2 adjusting entries for interest, right? So interest payable is an accrued liability, and that interest is owed, but it hasn't yet been paid. So we record it as a liability at the end of the period. Those were the journal entries we just did. A type of accrued liability that we may not have run into yet, but you probably know this because so many of you work, and we'll do an example, you know, on this just as soon as I finish explaining this, is salaries, commissions, and bonuses. All right, so there are accrued liabilities that come up in connection with compensation, right? Paying your employees if they've provided services, but the payment will only be made after the financial statements are, you know, complete. So what we mean is there could be people who are earning leave days, right? Paid time off during the year, but by December 31st, they haven't taken the time. And so at December 31st, we actually have to create a liability to show that we still owe people this time, because often the time that wasn't taken, if the person leaves the business, they will have that time paid out to them in the form of cash. So we can't just ignore that. When I used to audit, a lot of my clients sometimes forgot to accrue for the fact that, you know, people have earned leave days and they either take them or they have to be paid those days, and it can become a fairly big liability depending on how much people are earning, right? And so the expense that's relating to these, what they call compensated absences, which means sick leave, vacation days, holidays, things like that, should be recognized in the year when they are earned. So even if I'm earning my days in 2021, even if I'm only going to take them in 2022, the company has to record the liability at the end of 2021, okay? And the liability must be accrued if the person already rendered the services, they've already worked, so there should be an accrual for that. The paid absence or the compensation can be taken in a later year. So even though I worked in 2021, I can carry over some of my days into 2022. So it belongs to me, or I can get paid if I don't take the days, right? They also say that, you know, it's probable that the person will take the days, or that we'll have to pay out the compensation if they don't take the days, and the amount can be estimated. Right, so this is something, again, that especially if maybe you're working somewhere, if you're checking all the accruals for the end of the year, you want to make sure that the company is actually accruing for compensated absences. And then there's also bonuses. Bonuses are often earned during, you know, the fiscal year, but are often paid out after the year has already ended. Like a lot of companies that have December 31 year end, they only pay the bonuses in February of the next year, but that bonus relates to the previous year. So a 2021 bonus needs to be recorded as an accrual at the end of 2021, even if we are only paying out the bonus in 2022. All right, that's how we think about it. So questions on salaries or any compensated absences before we actually do an example on that? I'm just looking for a good example to start. I'm thinking if no one has any questions at the moment. So let's start with a more, I guess, quote unquote, simpler example for vacation pay, which is right here near the end of the page. I'm looking at this one. Give you a minute to find it. Number 22, I'm obviously not doing this in order, but the solution sheet that I have for all these questions that's in order. So don't panic, you'll be able to see everything in order on the solution sheet. All right, so let's read this. Caston Inc. provides paid vacations to its employees, meaning that when you take vacation, you actually are, still earning your salary. At December 31, 2012, 30 employees have each earned 2 weeks of vacation time. The employee's average salary is $500 per week. Prepare Caston's December 31, 2012 adjusting entry. All right. So now the question is, which accounts would be involved in this journal entry? And it's simpler than you might think. It's just going to be salaries and wages expense, because it's actually you record it as part of your salaries expense, and the credit goes to salaries and wages payable. All right. But now the question obviously becomes, what's the amount that we should record? So if employees have an average salary of $500 per week, and there's 2 weeks of vacation time that have to be accrued for, so that's 500 times 2, so that's $1,000 per employee, and there's 30 employees, that's $30,000, all right, that we will have to include as an expense and a liability. I will do the calculations on our work paper, but take down the question now if you haven't done that yet. Okay, so exercise 22. Again, the formal solution sheet will have all the questions in order. I know that it's a little bit weird to be jumping from one to the other, but this is how the questions, it's just how I put them on the sheet. So, so the amount owed, right? It's going to be weekly pay times the number of weeks times the number of employees. And so they said it was a $500 weekly pay. The number of weeks was 2, and the number of employees was 30. So that comes out to 30,000. All right. And so, like I said before, it's salaries and wages or just salaries expense. I mean, it depends on the company, what the name is for the account. And so there's a debit to an expense. And then salaries and wages payable is the credit. 30,000. And that's it. Right. So it's not like the journal entry is difficult. It's just that people forget, sometimes in practice, people forget to actually make the journal entry because they're not thinking about, vacation time that has to be taken in the future as a liability that exists today. But if you think about the definition of a liability, right, that exists in both the past, the present, and the future, it's a present obligation as a result of a past event. The past event is that people worked already, so we owe them the money, and there will be a future sacrifice of economic benefits. That's when they actually take the days off, right? That we will have to pay them for time that they're not working. So it definitely belongs in the definition of a liability. Questions on that? Okay, I'll give you a few seconds to take anything else down that you need to take down. Right. So let's just do the one quickly related to, let me see if I've got it here. Bonuses is also a simple one. Then I'll do one more for compensated absences. It's maybe not as simple, but we'll work through it together. And then I think we may be at time at that point. We have to leave some extra time at the end of the class. Okay. So let's just read this one. It's about bonuses. Again, a fairly, I think, fairly straightforward question, hopefully. Okay, so Mayaguez Corporation provides its officers with bonuses based on net income. For 2012, the bonuses total 350,000 and are paid on February the 15th, 2013. So they're paid the next year, right? We just spoke about that. Prepare the December 31, 2012 adjusting entry and the February 15, 2013 entry. And so basically they're just asking you to accrue for the bonus and then to show how the bonus is paid. I'll give you a minute to take down the question or take a picture of the question or whatever you need to do. Okay, so exercise 23. So 12/31/12, this is when you're accruing, right? When you're accruing for that bonus that that the people have earned. So it's going to be the same accounts. It's salaries and wages expense. $350,000. And salaries and wages payable. you know, sometimes I just want to mention this, that sometimes companies will use a separate account called liability for compensated future absences. You know, they can do that instead of saying salaries and wages payable, because they maybe want to separate out or use account. I'm going to write it here, liability future compensated absences. Maybe separate out the liability for the future absences from just the general liability for payroll, right? That might be smart to say, okay, we're not going to dump the future absences money in with just regular payroll that we run every 2 weeks. That's fine, right? So we could do it that way as well. So that's the accrual of the bonus. And then on February the 15th of the following year, it's just going to be getting rid of the payable, right? Because you're obviously paying out the entire amount for the people's bonuses, and you're going to credit cash. That's it. All right. With the compensated absences, you won't have just a payout the next year, because remember, that's about people taking days off. So with a bonus, you can show that the bonus is being paid. But with the vacation days and stuff, you have to wait to see what they actually take and then make adjustments that way. All right. Questions here? Right, I'll give it a minute for you to just take down anything else that needs to be taken down, and then we'll look at number 17 before we wrap this up. Okay, so number 17 is a little bit of a different setup in the way the question is written, and it looks somewhat harder than what it actually is, but I'll walk you through it, okay? It's also to do with compensated absences, and it's from the textbook. JWS Transport Company's employees earn vacation time at the rate of 1 hour per 40-hour work period. Okay, so 1 hour for every 40 hours that they work, basically. The vacation pay vests immediately. That means that they are basically, you know, going to, they don't have to, they've already worked, so there's no further waiting for the vacation to vest. That is, that if you let them go tomorrow, you will have to pay them their vacation pay because it belongs to them. Okay, they don't have to stay employed, which means they're just trying to say that a liability definitely exists. During 2021, total salaries paid to employees equaled $404,000, including $4,000 for vacations actually taken in 2021, but not including vacations related to 2021 that will be taken in 2022. Okay, so basically, if you look at this, they're saying 404,000 was paid, but 4,000 relates to vacation. So really what the people earned for 2021 was $400,000, okay? Because you're not going to use actual vacation pay in the calculation of what is still owed to them. So 404,000, but minus the 4,000. I'll explain that more on the sheet here. All vacations earned before 2021 were taken before January 2021. So they're trying to tell you there's no vacation pay related to 2020 in this number, okay? No accrual entries have been made for the vacations, no overtime premium, and no bonuses were paid during the period. So they're trying to tell you no one worked overtime, so you don't have to account for more than a 40-hour work week, okay? And there's no bonuses to accrue for. Prepare the appropriate adjusting entry for vacations earned but not taken in 2021. So take a minute and let this sink in, or take a picture of the question, ask me any questions that you have, maybe about the question, and then I'll work it out on the Google Doc. Okay, so hopefully you have the question. So let's go in and see if we can answer this. This is exercise 17. So the first question is how much, right? How much vacation pay was earned, right? How much vacation pay was earned. So they're saying it's 1/40th, 1 hour, sorry. 1 hour for every 40 hours worked, okay? And this total salaries were 404,000, but this includes 4,000 vacation pay. So to calculate what was earned, you cannot include vacation pay that was paid out basically in the calculation of vacation pay. So we have to remove vacation pay that was already paid, right? So that's 4,000. You got to get rid of that because you want to see what did people actually earn before we, involve any type of vacation pay. So this is the actual salaries for the year is 400,000, okay? Again, you cannot include something like vacation pay. You can't include the vacation pay in the calculation of vacation pay because then you're double counting, right? So we take out the vacation pay and then we use this net number, the actual salaries for the year, to calculate how much vacation pay was earned. So 400,000 is the actual salaries for the year. People earn 1 hour for every 40 hours worked. So no matter how you look at it, if you say they worked for 52 weeks, they worked 40 hours, their vacation pay is going to be 1/40th, right? 1/40th of their total pay because it's 1 hour for every 40 hours. And this number represents, for the 52 weeks of the year, and our vacation number will represent the same. So the vacation pay is going to be $400,000, right, that they earned, multiplied by 1 hour over 40 hours. I'm not saying that they only worked 40 hours for the year, but even if you multiply the 40 hours by 52 weeks and then say, I guess 52 over that denominator, you're still going to end up with 1/40th. Okay, trust me on the math. So that's going to come out to 10,000. So this is $10,000, not 10,000 hours, $10,000 vacation pay earned for the year. So I repeat, we had a total salaries number of 404,000. That already included 4,000 of vacation pay that was paid out. We removed the 4,000 because we can't include vacation pay in the calculation of vacation pay. That gave us salaries for the year of 400,000. The question tells us that they earn 1 hour of vacation for every 40 hours worked. So we need to take 1/40th of the total salaries as the vacation pay. That's $10,000. So total vacation pay is 10,000. What we already paid is 4,000 because that's from the question, right? It says that they already paid out 4,000 of vacation pay. So it must then mean that what is still owed is 6,000. And that's what we have to accrue for, right? You're going to have to accrue for this, right? Some people were already paid out their vacation pay, but for the rest that weren't paid, we have to accrue this $6,000. And so again, we're going to say salaries expense or salaries and wages expense, 6,000. And you can either say salaries and wages payable, or you can, remember I said you can use the liabilities for future compensated absences. I'm just using that since this is from the book, and I think the book favors the liability for future compensated absences account. But if you put salaries and wages payable, companies can also choose to do that. So I'll let it simmer here for a minute and see if someone has questions for me. Okay, that's time, and that's also where I'm gonna leave the work. Remember, I told you I'll try to put at least 20 minutes at the end for people to ask me questions. So I'm gonna stop the formal, chapter 13 work here. We'll pick it up again on Monday. For those who don't have questions for me, you're dismissed. Go and have a lovely Thanksgiving. Go and work on the paper. Do whatever you need to do. The paper's due at 6 o'clock. For those who do have questions about the paper or anything else, I'm going to stick around here. I'm going to give you another minute to write down anything you need to write down, and then I'll stop the share and stop the recording and just answer your questions. So in fact, I'm just going to stop the recording now.